And then, excellent. And then I should be able to click that. All right, Straight Griggs, founder of Sitting Wisdom. Excited to be with you today. We're actually going to do something a little bit different. I have a love of economics. Hopefully, you have noticed that in some of our discussions. And my love is so strong, I actually believe that if we understand the economics of a situation, we can actually make decisions that are in our own best interest. And I do think that that is where there's a disconnect. And so we're going to go through a handful of scenarios that are going on right now, some decisions that you can make, whether you're in your 20s and trying to get started, whether you're in your mid 40s or you're getting ready to retire, 5 to 10 years from retirement. Regardless, we're going to go through a handful of scenarios so that you're able to figure out what makes the most sense for really you. And so the goal today is for us to understand some of those hidden forces that we really call economics so that you can make a wiser decision in every single part of your life and so that you don't feel stressed, confused, or overwhelmed. And so the basis of today's discussion is focused on the idea that I'm looking at the stock market hits all-time highs, but if you're looking at most of the indicators are showing that the economy is struggling. The economy is not looking very good at all, and we'll go through some of those numbers because you really do have to understand why the stock market is going up to really understand what makes the most sense for you in your investment strategies, because it is going to be different depending on how close you are to retirement versus how far you are. So what we'll do is we'll start and I will go through a handful of events that will really paint the picture for you. So the first one is that the Feds approved a quarter point interest rate cut. And when you're talking about interest rate cuts, this is one of those indicators that makes it very clear that we're not looking good from an economic perspective. And so we talk a lot about the 4 seasons of economic growth, and I'm going to remind you of those. And then hopefully you'll be able to be like, yeah, okay, that makes sense, and I can make some sound decisions from there. So when you're asking me, well, Dre, if the stock market is going up, doesn't that mean that things are going very well? And the reality is, right, if you think of it from an economic perspective, there are 4 seasons. Every single year, you have the same normal 4 seasons, which is spring, summer, fall, winter. Economically, we have 4 seasons as well, right? I'm here on the side, so I could just have the numbers actually right up here. So the first season that you have is expansion. And you may hear that referred to as economic growth. That there is a time of economic growth, and normally that is a time of low interest rates. It makes making money really, really easy. Because if you think about it, if I was able to get money from you, right? So it's like, hey, I'm going to give you $100, and then it's like, all right, cool. And you said, hey, but I'm going to charge you 1%. And you're like, all right, well, that means I just need to have a 2% idea, and then I'm going to win by borrowing money from you. And that's really what most businesses are thinking. If you're buying a house, you're sort of making that same decision where you're like, okay, if interest rates are low, then when I buy a house, I can have the same monthly payment and have twice as much house. Obviously, that's a little aggressive, but you can have more house in the same monthly payment, right? And that's a fair statement. If you're a business and you have an idea and you're like, well, my idea is only going to generate me a 5% return, but that's okay because interest rates are at 2%, then you feel really good. Because interest rates have been a little bit high lately, because we have a good economic cycle, so you raise interest rates, that ended up causing a lot of businesses to slow down because now I have to have a good idea. I can't just go out and borrow money and then whatever works because it's okay, the money is free. Just like people aren't moving as much. Because if I have a historically low interest rate, right? If I have a 3% interest rate, why would I sell my house and get a 7%? And now I have less house in the same monthly payment. That math isn't mathing. And so a lot of people stopped moving out of their house, and then a lot of people stayed in their jobs because they're like, well, now people are getting laid off. I don't know if I'm going to deal with this. I'm not sure what's going on. And it slows the economy down. Well, in times of economic growth, you notice that we were not too long ago, we were literally at a 40-year high on inflation. And the reason we were at a 40-year high is because people had their COVID money. and people had new jobs that were paying them 2, 3 times as much because we had record and low unemployment. And so I had to offer you a pretty sweet deal to get you to leave your job. And everything from higher pay to more days off to working from home to a new title, all that stuff, if you remember, was on the board during record high inflationary times. Well, when everybody has all the money, what do most people do when they have a bunch of money? They spend it. And so people were out there buying houses and they were saying, look, I'll pay you $100,000 over asking price, $200,000 over asking price. There is not a number I won't say yes to. And that ends up causing inflation. Inflation is generally means that the economy is too hot, too quickly. And if you don't slow it down, you end up with hyperinflation. It just keeps growing to hyperinflation. So you can see why. All right, well, we must not be at risk of hyperinflation. You would be right that the economy is looking kind of rough right now. And so the interest rates are being dropped, because the risk of us being in a red hot economy that jumps into hyperinflation is no longer on the boards. And so then the second season ends up being the peak, right? So we peak out. At some point, the Fed says, okay, inflation's at a 40-year high. Okay, people are acting crazy paying $200,000 over asking price. Everybody's quitting their job and getting a new job and making too much money. I'm going to raise interest rates. And then that shifts the economy, makes it a little bit harder for there to be money flowing to buy the new house, to give over asking price. People stop getting their jobs, and at some point, people start losing their jobs, start laying people off. The juice isn't worth the squeeze. And as we slide down the peak, we go into a recession, which is where most people would acknowledge that we have been dangling around for, I don't know, like the past year. We'll just say the past year. That for the past year, we have basically been somewhere between like here and here, if you ask me, right? We've been basically somewhere between there and there. Because we're not at the bottom, the Fed is like, well, I'm not going to lower the interest rates too early. Because if I lower it too early, then we run the risk of running back up into the peak, and then we have hyperinflation. So they're waiting for the bottom, which is the fourth season, which we call a trough. And ladies and gentlemen, that is where most people are feeling that we're actually right around here now, that we're basically right around the bottom of the trough. Now you would say, all right, well, what does that mean for me and my money, right? Why is the stock market going up? And the reason the stock market is going up, because if you are saying, I'm going to lower interest rates, and I'm probably going to lower it 2 more times this year because we're at the risk of going into a depression. That's the only reason that you would lower interest rates, because you already feel that we're in a recession, but you don't want to go into a depression. So you're going to allow us to climb out of the recession back into expansion. So when you see all the economic indicators that are basically like, look, it's not looking good in the neighborhood, ultimately what the people who are betting on the stock market are saying is, yeah, that might hurt Main Street, but on Wall Street, that's going to be a great environment. We're going to get back into having very free and easy flowing money. And with free and easy flowing money, I'm going to be able to invest and grow my company, and we're going to get back into expansion. That is why the stock market is going up, while all the economic signals are showing that we're falling into a relatively deep recession. And so that's where that decision ultimately ends up coming, right? So hopefully that makes sense. Now, for the perspective of, well, why wouldn't they lower the rates earlier? That is right. That's the interesting thing. And the reason we don't lower it earlier is because if you lower the rates too early, you always risk hyperinflation. The only time you lower rates is when you're positive the economy is doing bad, which is the interesting dance, right? It's the interesting dance for the president to be like, hey, I want you to lower interest rates while saying we have the best economy ever, right? You can't lower the interest rates with the best economy because you just left it. You know what happens. People have too much money and they're just spending it on the most ridiculous ways, and the price of everything goes up. You have to be in a recession for me to lower the interest rates. And so, right, economically, you are in that top 1% that understands that. but most people don't understand that relationship. It goes together. That when interest rates are low, just think back the last time interest rates were low, what was going on? And you will say, oh, yeah, I know what was going on. We were not having a good economic climate. And so when the Feds lower the interest rate, and you can see here on the chart, when do we lower interest rates? The gray shows you the recession. I'm going to zoom in so you can see it a little bit cleaner. All right. And so you can see, all right, interest rates were a little bit higher. What happened? 9/11, boom, interest rates drop, recession. And then what? You climb out of the recession. So what do? Well, I don't want record high inflation. So I start raising rates to slow things down. And then, yes, you're right. Boom, you had a recession. What happened? The financial crisis happened. That's what that was in 2008. You have to lower interest rates. That's why they call it the Great Recession. It was such a rough time and a rough environment that we kept the interest rates literally at nothing until 2016. And we finally started seeing signs of economic growth. And then you can see the interest rate started climbing up again. And then what happened? That little squiggly of a gray, yes, that was COVID. It was the deepest and the shortest recession in US history. So what do? If we have a recession, we lower the interest rates because we don't want to go into a depression. So you always see that going together. And as you can see now, interest rates were at 5% and they started lowering them, and now they're at the 4 to 4.25. And I would not be surprised in next year's forecast that it will show the gray that will say, hey, we were in a recession, because that's the economic cycle. That is the dance. You don't lower rates unless there's a recession, because it's going to cause hyperinflation, and then your money isn't worth anything. And I think we all already acknowledge my money is already struggling with $40 trillion in debt, the value of the dollar anyways. Right. And so that was the first sign that we had seen. Right. So the Fed lowered it the quarter, and then you can see that they said they see 2 more coming this year, which is saying, hey, I don't think that this is a maybe we're in a recession. I'm not 100% sure we're in a recession. I'm saying this is definitely a recession. And when you're talking about it from the perspective of your investments, when you hear people say, and Warren Buffett's the one that's normally credited with it, that I'm cautious when people are greedy, and I'm greedy when people are cautious. Part of the reason why is because there's a lot of people that are now showing greed because they're like, interest rates are going to be low. Obviously, everybody's going to have great investments. I don't know that to be true. I don't know that everybody is going to have great investments, right? I don't know that to be true. And so then you would normally lean a little bit more on caution if you're within, let's say, like 5 years of retirement to retire, because you want to give yourself the wiggle room if something ends up happening, if the recession gets deeper, if someone does something stupid in the next 12 months, which is not off the board, as I would imagine you would understand that's not off the board to say that no one will do something dumb. And so normally you want to be cautious at these times when everybody is greedy, because the reason that they are greedy is the part that concerns us. Why are they being greedy? Because they said lower interest rates, right, means recession, but they said it means easy money. Okay. Well, does that sound like the recipe that would lend me to take on more risk because there's easy money? Well, yes, easy money. It will make everyone look good, as all of those other inflationary environments do, where you had, what was it? You remember, right? Those like tech stocks in the early 2000s, and then all those subprime mortgage loans. And then now we're sort of in the AI boom, where there's a lot of companies that have some AI numbers, and they haven't really done a lot with AI, where AI is just writing kids' college papers, but it's not doing everything that people said that it was. And you're like, okay, well, if the value isn't there, but the volume is going up, what does that mean for my money? And it means that people are gambling and not investing, which is why normally when I'm telling you, hey, the only reason the stock market is going up is because the interest rates are low, and people assume that the easy money is going to change everything. And it could, but it might not. And so that's what we mean when we say be cautious when other people are greedy, and then greedy when other people are cautious. And so you can see that the S&P 500 rate jumped to an all-time high a day after rate cuts. Small caps, those are companies that are normally under 10 billion, is on pace for a record close. So the idea is, if I have a smaller company, right, under 10 billion, so that's like your Costco's and your BJ's, right, like smaller companies that are regional. They're very successful, but they are regional. If they are doing very well, and they get more money, they might become a large cap company. They have the space to grow. That's the idea of a small cap. The small cap is like, what if I found Amazon when it was only worth like $10 million, and then I rode that wave to $1 trillion? What would I have today? Right? Like that's the idea. And so it is something that if you have more than 10 years available to work with some small caps, I think that that's fine. Small caps are more volatile because they don't have the ability to ride the waves like everyone else. And I can show you, I know that our bankruptcy filings are like in July was at a like an all-time high, not an all-time, but like a 5-year high. And let me see if I can find it for you real quick. All right. So you can see, right? So this is uscourts.gov. So they're like, hey, bankruptcy filings rise to 12% over the previous year. See that 12% for the period ending in June 30th, 2025. So then you're saying, well, dang, Dre, what the heck caused the 12% of businesses to file for bankruptcy? Well, these are some of the small caps, right? Like if you're dealing with smaller caps, you don't have the ability to eat some of these tariffs. And we'll talk a little bit about tariffs and some of these other costs. And I know people are like, no, Dre, tariffs don't impact anyone but the foreign country. I'm going to show you the economics of it. If you want to believe the economics of it, great. If you don't, it's fine. I'm not here to argue with it. But when you're looking at 12% up over the previous years, these are smaller companies that aren't able to navigate the tariffs at the same way larger companies do, right? So NVIDIA would be a great example of that. NVIDIA just said, I will pay the United States government 15% of our profits if you allow us to trade with China instead of the tariff embargo that is on China with their chips. And then the government, Trump administration was like, cool, no problem. But if you had a smaller company, could you offer that to the United States government? And they would say, cool, no problem. Don't worry about the tariffs. You could trade with whoever you want. And we would both agree, no, that wouldn't be the case. Intel is another example. Intel hit a high today. NVIDIA had invested in them, but Intel had given 10% of their company stake to the United States government, which is sort of weird, right? It feels like we're trying to out China instead of out America, where I don't know, and we'll talk about it and I'll show it to you, but I don't know about the idea of the government owning companies, right? Like if you just really think about it, you know me, I'm from the perspective of the citizen. I'm always going to fight for the citizen. I believe that you should have all the economic power that you can, which is why I encourage people to generate the income that you need, because our system tilts based on the money that you have. And it's not about assigning values. It's just about recognizing the fact that if you have the economic viability, then you can get the government to leave you alone. And I think that that's a fine place to be. And that if you're lucky enough, you can put enough plans in place where the government leaves your family alone. And I think that that's also a fantastic place to be. And that we're in a weird place right now in the country where half of the country is celebrating the government oppressing the other half. And then at some point they switch, and then the other half that was oppressed is now celebrating the government oppressing the other half, which net means that the entire country is oppressed, right? And so I'm not someone who subscribes to that. My goal is to help everyone to be literally free, financially free, economically free. One of my favorite African proverbs is wealth which enslaves the owner isn't wealth. And you can talk about that from a variety of influence ways, but I do think that all money isn't money that you should want. And so when you're looking at that, right, and I'll move on, but literally I was reading and I read that in Texas they had changed the districting to where 5 seats were lost. Well, that means that there's a handful of voters that are not being represented. And then the solution was for California to then change theirs so that 5 seats were lost the other way, which means that now there's 2 states where their citizens aren't being heard, that they're going to vote in a midterm and it's not going to impact the actual seats. And that to me is a travesty. And I think I read that there are 2 more states doing it. And it's like the country is literally celebrating the idea of them being removed from the process of controlling their government. And so economically, we got to do better, right? We literally we got to do better than that. And so you can see that the bankruptcies are up 12%. Why is that? Because of the tariffs that restrict my ability to get the products that I used to get, and I don't have the leverage to offset that. to where if I raise my price, you won't buy my stuff, because there's a larger company who is able to leverage that tariff away. And now I'm out of business and they're still not. That's why you see that. Again, another time when people are being greedy and we're being cautious. We're recognizing that the way everything is looking, it's not rainbows and Skittles, right? Like, we're recognizing the consolidation of things in a way where we're like, all right, I don't know. Well, you're like, all right, Dre, explain to me how that works, right? How does a tariff end up impacting the citizen? And I'm like, cool, I got you. Oh, totally. Because in economics, everything is a trade-off. Everything is a trade-off. You and I are making decisions with trade-offs. You decide what you want to do with your time. You can either go to work or you can go to sleep. You can't do both. Some of you may, but you generally can't do both. I'm going to go on a date, or I'm going to go on a jog, right? I can't do both. There's trade-offs with your time. There's trade-offs with your money. I'm putting my money in my investments. I'm going to spend the money on a new car. I'm going to put the money in fixing a new roof of my house. I'm going to spend the money on Christmas presents for my kids. But you can't spend the same dollar twice. And so we have trade-offs. We have to make the best decision for us and our goals, which is why I am a goal-based planner. So in your normal economy, you have the individual, and then you have the business. We'll just say person, so I don't have to write out individual. And we meet in two markets. Number one is we meet in the, actually, I did that wrong. Number one, we meet in the finished goods market. And so we'll just say finished goods. So if you sold me a house, I bought that house from a business. That's the only way I can get the house. For me to get the house, I had to give money. And so I do. I give money, and the money goes to the business. Well, where did that business get the money from? I'm glad that you asked. The business, well, where do we get the money from? We got the money from the raw materials market. So everything in our economy came from some raw material. Your countertops came from a rock where they shaved the rocks down, right? Like your granite countertops, your limestone countertops, like we know that's where your house, the wood for your house came from cutting some trees down. Okay, well, who cut the trees down? You. Right, so we give our time, that's my clock, and then we give them the resources. So we can give them the logs. So we go and we cut the trees down, and then we give them the logs. And for doing that, naturally, every business then pays us for our services. We give time, it gives us money. That is the economy in a nutshell. Every interaction is going to be an individual or a household with a firm or business. And then we trade our time and money back and forth, and we spend the money in one business, we work in another business, even if it's our own. And then somewhere in the middle, you end up with your government. And then depending on how active your government is, right? Ours has been more active lately than not. Your government ultimately decides how active it wants to be. And so when you go out and you purchase something, right? The idea of a tariff is to get people to buy US made goods. Now the tariff on India is actually made to get them not to buy Russian goods, but right, you get the idea. The idea of a tariff is to get you to buy US goods. Well, what happened? The house, if I use steel from China, China subsidizes the steel, so it's very cheap. It's a very cheap steel compared to US made steel. And so if I was to buy the steel from, let's say if I was to buy the steel from a Chinese company, let's say I got that steel for $20,000. And if I got that steel from US Steel, let's say it would have cost me $30,000. So the government says, I'm going to add a tariff, and that tariff is going to be like 15K. Right, so now the Chinese product is 35K. Right, and so then China has two choices. One is they still sell it for 20,000, knowing that they're going to take a $15,000 loss. And I'll let you decide whether you think that's what a business would decide to do. Or you will raise the price to that $35,000. So now which steel do you buy? Well, naturally you buy the US steel, right? We solved the problem. Yay. But what did it cost you? It cost you the ability to buy the steel at $20,000. And you see that. So in Target, there's lots of reasons that Target is not doing well. But from a tariff perspective, the reason Walmart is beating Target is because Walmart has 50% of their sales is groceries, 50%. And they source a lot of their groceries from the United States. And so they're able to work through a lot of these tariffs where they're offsetting the fact that their home goods is not doing that well. Target is only like 20% is groceries. So most of their stuff is in home goods isn't doing well, but it's a larger percentage of their revenue. And more of that is not sourced from the United States. So people aren't buying their stuff. If you look in Target, their costs are much higher than Walmart, and the stuff is relatively the same. I know you might be like, no, Dre, Target is way different. I get it. I acknowledge. I tip my hat to you. But I'm just saying that really they're substitutes. They're very similar, like Coke and Pepsi. I know you. I can't believe you said that, Dre. There is a big difference in taste. I know. Right, I'm married. My wife tells me there's a difference in things all the time, and I'm like, I don't recognize it, but I believe you. I believe it for you. And so you see that, all right, we worked. It worked. People are buying the US made item because that is now the cheapest item, but it costs you the other item. What ends up happening, without getting too economic for you, is basically there's a price that everybody is able to buy certain items. And as you raise the price of the items, there are some people who can't buy that item anymore. I think that's just generally a fair statement for all of us, that if you change the price to a certain price, all of us will stop buying it. I don't know, pick your favorite pizza. How much is the highest you'd be willing to pay for a pizza? Our numbers are going to be different. And based on that number is whether you go to an authentic Italian restaurant or you go to like Hungry Howie's or like Little Caesars, right? Like there's everything in between. And it varies for each of us. And for me, I love Chicago deep dish pizza, so I pay a little bit more for pizza if I get a Chicago deep dish. And outside of that, I just get a regular pizza. And so that ends up happening. So if I then add this tariff, then I add it to the price of the house, and then it's added to the price that you pay for the house. Because as a business, I have to cover the cost, right? I can't just eat the cost. I mean, I could, but as you already saw, there's many US companies that are unable, that had to eat the cost, and it took them out of business. 12% rise on the bankruptcies for US companies, right? It's very hard for me to have a price based on a certain market, and then you raise the price, and I can't raise my price and stay in business. And so we're starting to see that. And a lot of those tariffs have stayed in place where they're given 30-day, 90-day, 60-day pushbacks, and most of them have been allowed to go into effect now, and we're starting to see some of those numbers, right? And so you see that. Now, for those from the perspective of, well, Dre, it's obviously working for protecting American jobs, and that's fair that it will protect some American jobs. There, a good example of that would be the 100% tariff on electric cars. That's a large reason why Tesla even exists. That there is, I think 80% of the world's electric cars is made by this Chinese car making company. And it's because they make it for like a third of the price, right? It's like a really cheap car. But the cost of it makes an electric car, relatively speaking, unaffordable for most Americans. That's why most Americans don't drive electric cars, because they're unaffordable for the average American. And that's what you're going to see. That's why tariffs long-term don't work, because right, two things. If I put the tariff in and it generates a certain amount of revenue, but it costs a certain number of jobs, even if it's offsetting, I'd have to keep the tariffs on forever. Otherwise, as soon as I remove them, you're going to go back to buying the other goods. So basically, I've artificially increased the price of your goods forever, and that's going to have a lot of people feeling that I can't buy as much stuff as I used to, and you're going to feel uncomfortable, which is another reason that's leading kind of into those into the recessions and things like that as well. And so then you say, all right, well, Dre, then what's my thoughts on that? When you're talking about companies with tariffs, normally the way I would choose the companies that I would invest in or things like that is you're normally going to choose companies that have the ability to raise their prices and still make a sale, right? That's generally a high level the way you would think of it. And like Apple, we all already know Apple is charging a lot more than it costs them to make the item, and nobody bats an eye at it. Apple has the ability to raise its price, and that is still going to be a great investment for most people. And you can go down the list of different companies where it's like, look, if you have a moat is what we call it. It's like if you have something that makes you unique, right? We talk about the price of going to like Disney and other theme parks where they have intellectual property, where if you want to go on a Star Wars ride, there's only one place in the world you can go on a Star Wars ride, and that's going to be owned by Disney. And as a result, they have the ability to raise their prices. Where you look at even some of these streaming companies where they're able to raise their prices because they feel like they have the intellectual properties that you're willing to pay. And that's a lot of the reason you see NFL. I watch football, and it's like all the games are on like 8 different streaming networks, because every streaming network is like, people want to watch these football games, and if I can get them to add a subscription just so they can watch that game once a week, it's going to be economically worth it for me. And so you can see, as you look around, who has a strong enough brand that raising the price won't cause any issues. And then the opposite is normally what you're going to do. If you feel that someone doesn't have a strong enough brand, if I am buying your item because it is the cheapest in the market, I generally would not be someone that I would be looking to continue investing in. And so really we're talking about the idea, hey, look, right, why the stock market's soaring while the rest of the economy is struggling. We talked about it from an economic perspective, really have 3 things. And it's like, hey, number one is our choices and trade-offs. You and I are going to make choices, and it's going to have a cost. A lot of people ask me, hey, is this a bad idea or a good idea? And I tell people all the time, it's not really about if something is a good or a bad idea. It's what's the cost, and are you comfortable paying it, right? And that most things, it's a cost and a trade-off, and are you comfortable paying that? Right? They're like, hey, I want to do this for my kid. I'm like, okay, well, are you willing to increase your investments in retirement or retire 1 year later? And if that trade-off is fine for you and your goals, then we could do that. If you're like, well, no, that's not how I want to do it, then I'll say, okay, then we shouldn't do that. It's always an economic decision that's based on you, right? Debt versus investing. Should I pay it off or should I invest first? It depends. And then we talk about the market speaking. It's important to understand when the market is doing things. It's always a cycle. And from a wisdom perspective, it's like recognizing that cycle. Oh, here we go again. This is what always happens during that time. And then you make the right decisions leading up to that. And then just the government as a player. So we talked about how tariffs are raising some of the prices in some businesses, and it's also creating a little uncertainty in the market. And so with all things, whether you're a student or professional, you're young, you're 5 years from retirement, ultimately the decisions, there is right decisions. And when you're really thinking about it, the goal is to be able to make wise decisions in times of uncertainty. And that's kind of where we're at. So if you are someone that's like, man, this was pretty cool, I do have a handful of free resources for you. You can go to happilyretire.com and you can take advantage of them. I'm always thankful for the time that we have together. Until next time, stay safe and enjoy life.